In the meantime, we have Mahantesh Sabarad ready with us, and he is joining in from SBI Capital Securities. Mahantesh, hi there. Good afternoon. What is your take on the overall election outcome in terms of how the markets are potentially going to react? Do you think that irrespective of what we get, we are going to see, some sort of an up move in the equity markets, or are you betting on, the election verdict being driving the market sentiment largely?
Yes, so good afternoon. So as far as the election outcome is concerned, I think the market is already pricing it in. We saw a huge pre-election rally in the month of March, whereby the indices went up by almost 8% and therefore any outcome which is unfavorable to the market, when I say unfavorable, right now the market is assuming there will be continuity in the government. That means the current government will be able to form the new government, although certain numbers might change. That continuity would mean continuity in policies and the expectations of the markets are falling in the known zone. If there is a new government formation that takes place, then we enter into an unknown zone as far as policy environment is concerned, and probably that will disturb the market's momentum. But the downfall might, after such an event outcome, the downfall that can be seen will probably get quickly absorbed, because we will soon focus on to the earnings momentum that will present itself as we move forward.
Right. Mahantesh, what according to you is the positioning on Infi and TCS ahead of the numbers?
So I think ahead of the numbers, most of the analysts as well as the market are looking for a bit of subdued earnings, accompanied by not so great commentary as far as guidance is concerned. Obviously TCS doesn't give a absolute guidance number, but what we would be seeing is that there are several headwinds that both the managements will potentially talk about. Headwinds related to costs emanating from the new visa norms, headwinds related to currency, headwinds related to global slowdown, and other headwinds related to consolidation that is generally seen among global peers. So I think the markets are already factoring in a bout of negativity as far as the IT companies' results are concerned.
About HUL and ITC, Mahantesh, and what you see happening there today. Of course, you've got ITC, one of the top movers. HUL has been moving pretty much all week, actually. What do you feel is really happening here when it comes to the FMCG majors?
So this quarter will signal the completion of the entire base effect, which we had seen emanating from the demonetization as well as the GST implementation. So going forward, it will be very difficult for both these companies to maintain the volume growth story, especially in an environment where forecasts coming in for monsoons appear to be quite weak. That means we are potentially headed for lower rainfall, and that doesn't really augur well for FMCG companies. Both these companies have substantial revenues coming from on the FMCG side. But the good news for both of them is that there is an element of pricing growth that is being seen in certain categories. Premiumization is continuing to happen, and therefore they should be able to compensate for the slight subdued volume growth by better pricing growth and maintain therefore the revenue growth momentum we have thus far seen. So all in all, I think they should be marginally positive as we go forward, although they also will face headwinds, particularly from the lower monsoons.
Let's also talk about auto, Mahantesh. It's something else we've been talking about today. We've had positive commentary coming in, or brokerage reports from certain counters in the auto space. We've also had a fair amount of movement in some of those stocks, including Maruti continuing today. Tata Motors, we've seen the story play out over the last few sessions, almost a month now, I think. And we had some movement even in some of the two-wheelers. Would you get into auto now at these levels? Would you wait perhaps for some more trigger points, earnings, monsoons? How would you strategize here?
So we have been actually advising people to really look at the automobile OEMs. In the past, we weren't so gung-ho about the sector, but it's been, I would say, a month or so that we are telling our clients to get into auto OEMs. But then the way the approach that we particularly have is that look at those companies which are which have a solid balance sheet. By that I mean a company which has substantial cash reserves and is not unduly indebted. Automobile companies, barring a couple of them, do possess strong balance sheets, and the bottoming out is already being seen. When I say bottoming out, I'm essentially referring to the volume growth numbers that they report every month. So the degrowth phase is sort of getting over, and a low base is already getting set in. That means year in onwards we should be able to see growth pick up as the environment eases on let's say the financing side, as well as the environment improves as far as the economy is concerned, and so on and so forth. Although some element of headwind from poor monsoons might hit the companies, but today would be the time to get into automobile companies, barring a couple of them.
Right. Okay. The take coming in on auto. Just want to identify some of the other stocks, the active F&O movers, and CEAT is an interesting name from the tire space. Open interest up nearly 12%, and you're seeing some long build up there on the stock. You've also got something like an IGL, which is looking quite perky right now, a 17% OI open interest, and you're seeing some long build up there. You've got ITC as well as that ABHA flagged off. So those are some of the interesting stocks that are quite upbeat. Mahantesh, wanted to get in your take on the OMC basket. We've seen quite a bit of volatility of late, of course, very contingent on the way crude oil prices move. But the general expectation is that we're going to see robust marketing margins across the board. What are you expecting from OMCs? Would you play them ahead of the earnings?
So yes, we have been quite positive of the OMC sector, and unlike the perception that most people have about oil marketing companies that they are commodity plays, we hold a different view. We say no, they're not necessarily a commodity play. They are value-added kind of players. They have huge reach as far as their marketing is concerned, and we particularly in India have a steady growth in petroleum products, and that growth is not going to slow down any soon. Therefore, the prospects are really bright for the oil marketing companies. We did have a problem with them in the past when the government announced a cut in the fuel prices and asked the oil marketing companies to bear part of the load. We saw those companies' stock prices dip by almost 30–40%, but they have substantially recovered. The strength of the recovery itself tells you that these companies are generally perceived to be good companies in the markets, and that's exactly the viewpoint that we hold, irrespective of the refining margin growth or degrowth that we see periodically. We think the oil marketing companies would be on a longer term basis drive sustainable growth through better efficiencies coming in.
Right. Okay, that's the word coming in on some of the OMCs, which definitely would be a beneficiary with regards to the spike up in crude prices. But Mahantesh, what about the consumers? How is it that you approach aviation? And amidst this entire drama that's playing out with Jet, we don't know who the taker is going to be, the bidding process still on. How would you approach both Jet? Is it a story you avoid? And do you then profit take from an Indigo and Spice Jet, which have actually run up in the last 3 months?
So generally we advise our clients to stay away from the aviation sector. They are far too volatile, and they are companies who are not known to deliver sustainable profit growth. They are subject to volatility in crude prices. They get hurt by any rupee depreciation that happens, and there is competitive intensity is pretty high. So without taking any particular name or any particular airline, we tell the investors to generally stay away from the aviation sector. As far as your question on particularly on the names, I think Indigo is in a far better shape relative to the other airline companies, simply because it's from a balance sheet point of view, it's zero debt. It's actually a net cash surplus kind of company. It is facing problems. It is also facing headwinds related to dipping yields, related to rising costs, and so on and so forth. And their ambitions to grow internationally will introduce certain elements of cost which are hitherto not predictable. So from a futuristic point of view, while Indigo seems to be the better of the lot, it's not something that we typically advise our investors to get into.
But Mahantesh, what about the broader market? When will it catch up? Although it already has in bits and starts, but when do we see a full-fledged recovery coming in for mid and small caps?
I think the focus will be more on the earnings as far as mid and small caps are concerned. There's a lot of disappointment we have seen on the earnings front, particularly after that volatile phase we saw post GST implementation, where there were a lot of hopes built up around the fact that a lot of these listed companies who are organized players would see the unorganized competition go away and therefore be able to consolidate their businesses. So that hope has actually been dashed, because we haven't seen a wholesome growth either in revenues being posted by these small and mid-cap companies, nor have we seen any uptick in terms of profitability margins. But that hope is sort of getting revived once again, because like I mentioned some time ago, the base effect related to the GST is now sort of over. So whatever we incrementally will see going forward would be on the strength of the company's earnings. So stock price movements for the small and mid cap will be crucially dependent on what the earnings will be and what the forecasts are likely to be. One will have to really weed out the losers and pick the winners going forward. So broader market may not necessarily have a runaway rally, because the losers kind of stocks will further fall, the winners will rise, eventually keeping the market steady. But hopefully we will have the markets going through that phase of consolidation and will in the long term rise.
All right, Mahantesh, thanks very much for taking time out and sharing with us your views. To have a good weekend.